So our first presentation is on how share repurchases affect investments. Are they good for us? Are they bad for us? If they're good, why are they good? How are they good? So I mentioned that in making decisions, we always have of course, our brain that tries to make rational and logical decisions. And there's also our intuition, our feeling, and what feels right in our gut, in our stomach. And a lot of times it's good to also listen to your gut when you make decisions, right? Because we feel things that are maybe not so right, and they help our rational. In investing, we have to be careful. I'm not saying that intuition is not helpful in investing. It can be, but it can also be very tricky. So one example is, as probably everybody in the room and online feels, is when our investments go up, like we're right now invested only in stocks, right? When they go up, we're like, okay, this is going well. This is perfect. We did the right thing. We're very smart to invest in these companies. And when they go down, we're like, okay, maybe I should have done something else with my money. Was this the right thing or not? Maybe I should have waited 3 more months before I bought that stock. Right now it's 30% down. That's very natural to feel that way, right? But if you're invested in the right companies, and if you have the time horizon that most of us have from an investment perspective, it's actually a counterintuitive feeling that we have. We should be feeling the other way. So when our stocks go up, we're like okay, it would actually be better if they don't go up or if they go down, because most of us, we are still making more money than we're spending. So we have some savings, and that savings needs to be put somewhere, right? It needs to be invested. It doesn't have to be in stocks. It can be in other things. But as long as we have more money to invest than we're consuming, it's actually better, for example, if our stocks don't go up, right? And I have to catch myself all the time. I'm doing this for now 15 years, and I still catch myself. I'm like, oh, it's something went up 20%. This is really good. I'm like, actually, I know what the company is worth, or I think I know what the company is worth. And if it went down 20%, right? If people become more pessimistic about it, but I don't share that degree of pessimism, I actually want it to go down 20%, right? So for me, it's like all the time when I'm writing to you, sometimes it's like with a laughing eye, sometimes it's with a crying eye, right? Because I'm like, okay, it went down. Okay, I have to report negative performance, but on the other hand, we can actually get much more of the company that we like. So that's why I want to explain that intuition can be very tricky in investing. But let me tell you why it's actually good for our stocks or other investments that we may have over time, if it goes down or doesn't go up in the short and medium term. So if you think as an owner, so I made the analogy for, like, let's say you have a favorite brand of clothing that you like, or a favorite wine that you like, or a favorite car, and you've been either consuming it and buying more of it, or you've been saving for it, right? You would be happy if that car, that wine, that handbag, or whatever it is, that TV station that you want to have, is on sale, right? It's like, okay, now I don't have to spend as much money, or I can get more of the wine, right? For example, right? But in investing, we have to force ourselves to think that way. It doesn't come intuitively, right? And if you think as an owner, so we're right now in this hotel, right? Some people, let's say the hotel doesn't belong 100% to us. We own 50% of it, and somebody else owns the other half, right? And they become pessimistic because they're like, I don't know, this region and the weather is not great. Maybe I shouldn't have made this investment. If I can sell it with with $1 million of loss, I'd be happy to do it. And we look at it and we say, okay, no, weather is getting warmer in Switzerland over time, and the cautiousness there is not going anywhere. We think it's actually a good deal, and we can buy that 50% from the other person on a discount because that person is pessimistic, right? So that's the mentality we should have as long-term investors and as savers, right? And then hopefully when we're then much older, and we need to divest, then obviously we want the stock prices to be high, right? So that's the first reason. We can buy more of the things that we understand and value for less money, and that's a good thing. The other thing is the type of businesses that I try to invest in for us. These are strong businesses. They have strong business models, they have strong management, and they have financial strengths. So I always look for companies that in times of stress are still well protected, right? And strong businesses, if I can identify them, they actually benefit in two ways. One is what happens when the economy is tough, right? When there's a crisis in the world, when the sales and revenues aren't coming in as expected, right? So companies usually say, okay, we have to step on the brakes, right? And the weaker they are, the more they have to step on the brakes. And the stronger a business is, the less they're forced to step on the brakes, right? So while weaker companies say, okay, we can't afford the marketing anymore, we have to cut research and development, right? Maybe we don't hire the talent that we were looking for, or we postpone it. Maybe we have to let good talent go because we just can't afford it, right? They fire people, right? And maybe we don't build this factory that we wanted to build, right? We wait with it, right? Or they're forced to sell some factories, right? So this is what happens with the weak companies. And the strong companies, when they have financial strengths and a better business model, they're like, okay, our revenues are a little bit better protected, right? We have a little bit of pricing power, right? We can maybe negotiate with our suppliers a little bit more because we're stronger, right? And we have ample cash, right? We don't have that much debt, right? They can come and say, okay, now others aren't advertising. To advertise is actually cheaper, right? To build that factory is actually cheaper because I can get the supplies, I can buy the land cheaper, right? Talent is available. Now not everybody is hiring. I can get the best talent and maybe I don't have to pay exorbitant salaries, right? Research and development, I can still continue. So they see actually the opportunity. There's a vacuum because others are, stepping back. They say, okay, we jump into the vacuum and we invest now. Okay. We keep our investments or we invest even more because it's cheaper to do it now. And with that, those strong companies, when the crisis is over, are even in a better position and the weaker companies in a worse position. So they actually can widen the gap.
So what's the difference between the weak and the strong company?
What
are the key aspects? Net trading, enough cash flow.
Yeah. I mean, it's all those things. It's the financial strengths, right? Yeah. It's the management, right? It's the talent that they have. It's the business model. Is it a better protected business model than other business models, right? It's the capital intensity. How capital intensive is the business, right? When it goes through a cycle, right? And it's very capital intensive. You can't just stop investing, right? And things, you don't have purchasing power that much when it's capital intensive. So there's a lot of things that come together, and we can talk about when we talk about our companies, why I believe these are stronger businesses. But it's all of these things coming together. It's not one aspect, right? And the more of those aspects you have, the stronger the business is, the better they're able to actually benefit from crisis, right? So they can widen the gap, in short, right? So even if we can't buy more because we're already fully invested, if the stock prices go down, usually the stock prices go down because something is happening in the economy, right? People are less optimistic. Then our businesses actually benefit, right? Even if we can't buy more. If we can buy more, that's an added bonus, right? So that's one. The other thing is, when the economy is bad, things are going down, people are panicking, or at least not prospering, the stock prices of other companies also going down, right? So now the strong companies can come in and they say, okay, I always liked that competitor. Not as a competitor, but it's a great business, right? I've had a tough time with it, and now they're struggling, and the stock price is in the basement, right? Now, if they have ample cash, they can actually go and purchase that company, maybe, right? Creating less competition, at least for a couple of years, right? So that's also good, right? So strong companies, they can widen the gap and they can potentially buy their competitors and have more market share. So that's why strong businesses, they benefit from tough times. And there's a third thing, patient investors in these strong businesses, they profit actually even more. And that's the topic of this presentation. They profit even more because strong businesses can repurchase their own shares at a discount during tough times, right? So I've written about this in my letters a lot, about share repurchases and why we benefit from them. And this is the third kicker. And I want to explain to you, but then I realize, okay, you all have different things that you're focused on. Maybe share repurchases is not top of your mind. You're not thinking about it every week, right? What does it actually mean to repurchase your own shares, right? How does that work? What is the effect of it? And that's what I want to present in this presentation. So what is a share repurchase? It's actually pretty simple, right? Companies use their own cash that they have on their balance sheet in the stock market, just like we buy stocks and sell stocks. They can sell stocks when they want to issue more shares, right? But when they repurchase, they take their own cash, which is our cash as owners, right? And they buy their own share, just like we buy their stocks, right? They buy these, and then typically they cancel them. So they take it out of circulation. So let's say a company has 1 million shares, they go out and buy 100,000 of those shares, and they cancel them, then there's only 900,000 shares left. That's all it is, right? So as a result, the shareholders that sold the 100,000 shares, they don't have them anymore. The company has them, they cancel them, they're less shares, right? So those shareholders, they're gone. They buy something else, or they buy real estate or whatever, right? Or they spend the cash. The shareholders who didn't sell, so they still own the 900,000 shares that they owned before, but now they're not 1 million shares in total, or they're now only 900,000 shares. So every shareholder that didn't sell owns a little more of the company without having to put up any cash. Does that make sense?
Mm-hmm.
Okay. So, and share repurchases can be smart or dumb, right? When they're done smart, the remaining shareholders are richer. When they're done poorly, remaining shareholders are poorer. And that's what we want to look at. When are they smart? So there are two conditions when share repurchases are actually smart. One is the company, the firm, has enough money to build the business to its full potential, right? It's because it's always advantageous if they have good investment opportunities, if they can conquer a new market, create a new product, create a loyalty program, whatever it is, right, that creates shareholder value. It's always advantageous if they do that, right? So they should always make sure they have enough cash to do with the business what they can do, right? So things that are promising. If they can do that, they should do that. But a lot of companies have more cash, either on the balance sheet or because every year more cash comes in, then they can sensibly invest. I mean, you can open the window and throw out the money. A lot of companies do that too, right? But if you've done the smart investments and there are no obvious smart investments left, and you still have cash left, what do you do with that, right? You can pay down your debt if you have debt. You can pay out dividends to the shareholders, or you can repurchase shares, right? So if the first condition is met, the business has enough cash to be built to its full potential, there's cash left. Now you can think about, okay, should I repurchase shares? And then obviously it makes sense to repurchase shares when the stock prices are below what they're worth, right? So if you think about it, you say, okay, this company is worth approximately this much. We have 1 million shares. You divide it by the number of shares, you get to an intrinsic value, what the business is worth, right? and you see the shares are a fraction of that,
So you've made a good deal.
you made a good deal. You pay with your cash, the cash goes out, right? There are less shares left, but at a discount. A lot of companies do other things. They're like, okay, we're giving stock options, and now in order not to dilute the investors, we're going to repurchase shares. That doesn't make sense. I mean, it can make sense. It cannot make sense. It depends really if your stock price is undervalued or not. Right?
That's an interesting fact. Who is the company?
Who is the company? Yeah. I mean, we are the owners of the company, right? And then there's the management, right?
Yeah.
Yeah. And we try to be invested in companies where the management is shareholder friendly and sees themselves also as owners and thinks on our behalf to our advantage, right? A lot of companies repurchase shares because of reasons that are not rational, at least not for the shareholders, right? Because when you repurchase shares, you push up the stock price too, right? And when your stock options are tied to that, as a management, like you have incentives to do that, right? So you have to be very careful.
Exactly. That's
When
that means views of the management and the shareholder.
yes,
Are they aligned or not aligned?
yeah, that's very, very important. Exactly. That is very important.
Another
Yeah.
one. So if I want to have the benefit for a shareholder, I also could increase dividends. So that's why I just gave in mind. If I repurchase, I also pushing up the stocks. So as a manager, I could have a short-term view.
Yeah.
And with dividends, I also profit as shareholder.
Yeah.
From the following, because I'm getting more of my stock. So
Yeah.
I'm getting more parts, or I'm getting dividends.
Yeah.
And it's more long-term.
Yeah.
Well, we'll get into dividends
Yeah.
because, as I said, if the business has more cash than it knows what to do with, they can either pay down debt, right? They can pay dividends, or they can repurchase shares, right? So, and then we'll look at which one is actually more advantageous. But just to be sure, I mean, share repurchases, they need to meet these two conditions. When they do meet these two conditions, then it's actually the best way to increase shareholder value.
What about the situation if you repurchase shares
Mhm.
and you don't
Peter, if you speak a little bit louder so that
you don't kill
yeah.
it, you don't cancel it,
Yeah,
but you give it away for like a form of salary bonus.
yeah, that's true. I mean, some companies, they repurchase their shares. For
Yeah.
example, Grenke is doing that right now, and I'm not sure if they're going to cancel it. They might, because further down the road, they might need the capital again to grow, right? So they're like, okay, right now the stock price is very undervalued. We're going to repurchase shares, right? Maybe in a year or 2 or 3, they will say, okay, in order to grow, continue to grow, we need more capital. So we're going to sell those shares that we repurchased back to the market to get back capital, but hopefully at that time at much higher prices, right?
Yeah.
So that's one. The other thing is they hold it back because they say, okay, we want to have give options to our employees to become owners. And if it's cheap now, we'll buy it now, and then we'll incentivize our employees with it. Yes, that's also an option.
It's the same effect than
absolutely.
They give it on the free market
Yeah.
because you save on salaries,
Mhm.
you give away stock,
Yeah, absolutely.
so you have more cash.
Yeah. And it still makes sense to repurchase them when they're on a discount, right?
Yeah.
You should always try to pay less for things than they're worth. So that makes sense. Yeah. I just want to, because I don't see you guys in the room, are there any online, any questions from the partners who are listening in online? Are you still there?
Yes,
Yes,
there
no
are good.
questions, I think.
Are there any questions?
No.
No, okay. At any time, we can hear you well in the room. So at any time, if you have any questions, because I can't see you, I can see the presentation. At any time, if you have questions, please just scream into your microphones, okay? Okay. So I hope that this is both online and here readable. Jürgen, you brought up the point of paying dividends, right?
Yeah.
So let's look at that. And I've created two cases. So we have business A. We call business A the dividend payer, right? And we look at how that investment is going to go. And it's a good business. It has a return on equity of 20%. So return on equity means, how much is the company's own equity worth, right? So all the assets minus all the liabilities, that's the equity. So on that net worth, they're earning 20% every year, right? That's pretty good business, right? And they decide, okay, we can reinvest half of that money that we're making every year, right? We have sensible projects, we can expand internationally, whatever. Half of that we can reinvest in the business, right? And the other half, we don't have anything that makes sense to invest in, that's attractive. We're going to pay it out. So the payout ratio is 50%, right? So imagine here they have equity of 100, they earn 20, they pay dividends of 10 because they're like, okay, if we invest it, it's not going to produce a good return. We might as well give it to the investors, to the shareholders, right? And they don't purchase any shares, repurchase any shares, 0, right? So next year, now because they've reinvested 10, half of it, now the equity is 110, they earn another 20%, so 22, right? They reinvest 11 and pay out 11, right? And this continues for 10 years, right? Pretty good, very good business, 20% is paying half of the earnings in cash out to us. Nice thing. Okay. Let's say they have 100 shares and they are valued at the PE ratio of 8. PE ratio means what are investors willing to pay for the earnings, right? So PE ratio of 8 means if they're making 20 earnings of 20, the stock market says, okay, they're worth 160. So 8 times 20, right? This is the assumption. Okay, that's how they're valued in the market, right? And then the share price is the market
Key
capital.
factors are important for this PE ratio.
Sorry, say it.
Which factors
This
are
yeah.
influencing this PE ratio?
In the long term, it's how much cash can the company produce and pay out, right? In the short term, it's all expectations and fears and greed and emotions and China and USA barking at each other and COVID breaking out. It's all those things, right?
Okay.
Yeah, it's a voting machine in the short term of what all the investors think in the stock market.
And your assumption by filling out this table was the more money, the more interest you get on your shares, the more dividend they pay out, the higher this ratio is.
No, the PE ratio is just an assumption. I'm saying, okay, it's only valued at 8 times earnings, right? Which is a rather low earning multiple,
I don't get
right?
it. What is it? This ratio?
It just
Why is
says
this important?
it just says how the company is valued in the market. So if a company has a PE of 8, it means that investors are only wait for every dollar of earnings that the company makes. Investors are only
Okay.
valuing it at 8,
Okay.
right? So if you're I don't know, Coca-Cola and you make 10
But
billion,
it's just theoretically, right?
yeah,
So
that's
it doesn't
no,
really- okay.
yeah, this is just the case, right?
Okay.
So is business A has these characteristics here and is currently valued in the market at 8 times its earnings, right? Whatever earnings it's making, the market says, I don't know. I'm only willing to pay 8 times as much.
But
Right?
why is it always growing?
But I'm sorry to interject here.
Yeah.
Is it possible that we don't see the same screen as you in the room? Because we still see your very first slide here online. We don't see anything else.
Oh,
And you're referring to stuff and your cursor's moving, so I'm not sure if we see the same thing.
yeah. Thanks for letting me know. I am on slide 7. you should see business A
Yeah, we see.
dividend.
Yeah, we see.
Now we see
seven.
it.
Now we can see that now.
Oh.
So far we're stuck on slide 1.
Okay.
Doesn't
Probably
synchronize.
best to keep this one.
Yeah,
Yeah, probably
Um,
better.
if you keep it in a not presentation mode.
Yeah.
Are you seeing now slide number 7, everyone?
Yes.
Yep.
Yes.
And if
Okay.
you make the agenda to the left a bit smaller
Yeah.
and the
Yes.
screen in the middle a bit bigger, I think it's quite nice. And also you can delete the top line here. So then I think it should be big enough for everybody.
Yeah.
If you click the bottom, the mini.
That works.
Okay. Thank you
Thanks.
for letting me know.
Maybe to add to the PE ratio, I think, because the German expression is Kursgewinnverhältnis, no?
Yeah.
And that's more logical in a way.
Yeah.
Because when you purchase a holiday flat, then you you take credit for the holiday flat. If you take the credit for the holiday flat, you're calculating how much I can rent it out per year. Huh?
Mhm.
That's the Gewinn year, 20%.
Okay.
And then you're thinking about okay, how many years I want to have, I need to wait until my investment is even.
Mhm.
So, okay, I buy now something and maybe here in 8 years, it's even. So I've paid off my credit for my holiday flat. This is right.
Exactly.
And that's always in the media. So how much,
Yes.
how sometimes you have a Kursgewinnverhältnis from 20 years. Yeah? Nowadays in IMO markets, 20 years, and sometimes even 30 years. So it's like how much is in the future that there's to break even.
Exactly. And that's why I asked, is there direct relation to the dividend paid out? Because the higher the dividend paid out, so in your example, it's the higher the rent out.
Yeah, it should have an
Income.
impact. Yeah.
Yeah, I mean,
But sorry, so did I get you right? With your example, with
Yeah.
your holiday flat, so the lower the number, the better, right?
yes.
Okay, so the higher.
Yeah.
Okay, all right.
Yeah.
So it's going to a negative direction in this case.
No, this just means this business has this characteristics. It's earning 20% on its capital every
Mhm.
year.
Mhm.
Half of it can reinvest in the business. Half of it cannot reinvest sensibly, so it's paying out half of the earnings, right? And it's not repurchasing any shares. And so here you can see every year, okay, it's earning 20%. So it is growing. That's why it's growing, because every year it's earning 20%. But it's only reinvesting half of it, and half of it is paying out, right? And this is the number of shares.
Yes.
The price to earnings ratio, or in German Kursgewinnverhältnis, just says how is it valued currently by investors, right?
Okay.
And a lot of things like the payout ratio, they play a role. Other things, growth plays a role. Macroeconomics, everything plays a role. But in this case, we assume it's valued at only 8 times its earnings, right? So the market cap is 160. If you divide it by the number of shares, it means the share price is 1.6. And if we take this example forward, so every year it's earning 20%, paying 50% in dividends. We add up all the dividends paid over the years, right? You can see it here. And we also, of course, dividends today are more valuable than dividends in 10 years, because 10 years inflation is going to be something else. So we need a discount factor or a present value factor. And we reinvest the dividends and we calculate it out. It leads, for this great business, the terminal value in 10 years is going to be 12, right? Someone wants to come into the meeting. Just a second. Oh, how do I admit that?
Yeah, there was an admit button on the right side.
Where is it?
Oh, I thought you admitted already.
Someone wants to join this call. There. Okay. So, all right. Moin, Mark. So, this business that is currently worth a share price of 1.6, it's a good business because it's earning that. Over 10 years, with these assumptions, it's going to be worth 12, right? So it's pretty good, yeah? An internal rate of return of 22% per year. And so your capital, if you invest 1 million in it now, in 10 years, it will be 7.5 million, right? It's a good business. It's earning 20% on its capital every year and paying 50% dividend rate, right? Very, very good business. You can 7.5 times multiply your capital by 7.5 times in 10 years, right? So this is our dividend payer. Now let's take the same business and with the same valuation. So, and by the way, what I forgot to mention, currently it's what the assumption is I'm making here is currently it's undervalued. It's at a PE ratio of 8. And in 10 years, people recognize that it's a great business and the PE ratio. So what investors are willing to pay for it in 10 years is 20, right? So the valuation went up. People are more, they recognize it, right? But we use the same assumptions for the second company. The second company is a repurchaser, right? Instead of paying dividends, it repurchases its shares. So same situation. Return on equity is 20%. This time, it doesn't pay out any dividends, 0, right? It reinvests half of the earnings back into the business, and the other half, it says, okay, I can't reinvest sensibly in the business. I'm going to repurchase my shares because they're cheap, right? When you do the same thing with this company, what you recognize is the number of shares goes down, right? Because it's taking 10 at the share price of 1.6, purchasing 6.2 shares back this year, for example, right? So the number of shares continues to go down every year where the company is repurchasing shares and canceling them, right? And you can see the share price increases more. Why? The earnings are going to be the same, but the number of shares, so the denominator has decreased, right? So we own more of that business. We get more of the earnings. Belongs to us now because of the repurchases. And what you see is the same business that started with a PE ratio of 8 and ended with a PE ratio of 20, the share price went from 1.6 to 17. The other one went to 12, right? So the IRR, the rate of return per year, is 26.7%. And now your 1 million didn't become 7.5 million, but 10.6 million, right? So now we have 3 million more out of an investment of 1 million for the same business, just because the company decided to allocate its capital differently. Instead of paying dividends, it said, no, the stock price is cheap, I'm going to repurchase shares. Okay?
So in your example, for repurchasing, it was also 10% of
50% of the earnings
50% of the earnings
is used for repurchase. Yeah, exactly the same. Yeah. So in this sense, you can see that repurchasing versus paying dividends is actually a much better way of giving value back to shareholders, right? And by the way, shareholders, they can create their own dividend if they want to by selling small portions of what they own. Because with the repurchases, right, we own more of the business. We could decide to sell a little bit of the shares that we own and still own the same amount. So you can also recreate your own dividends, but that's for another day, or maybe for the question and answer sessions, right? I just want to show you that capital allocation is extremely important for the returns that we earn, right? And I'm very, very happy that our companies are repurchasing shares, because my job is to find things that are undervalued, right? So if I'm right, but yeah, by definition, I do want them to repurchase shares, right? If they can't invest it in the business sense.
There are some questions, I guess.
Oh,
Yeah, I have thanks, that was fast. Which companies are doing it in our portfolio?
they're actually 85% of our portfolio is currently significantly buying back shares. So
Okay.
there are only very few that are not. Tesla is not buying back shares right now.
The reason why they're not Tesla?
They invest.
They have,
Okay.
they have, I go back to this slide.
Yeah.
Yeah. does the company have more money than it needs to build the business? I think Tesla right now, they think they can use the capital better by investing it into the business, and I think they're right.
Okay.
Your comparison now, isn't that true only? Isn't that only true in a one company investment strategy? Because if I get dividends year on year, I won't just have them sitting there, right? So I'll reinvest them into something that's making me money, and potentially I find a better investment than what the company can give me, and I outperform that additional 3 million roughly that you would get through a share repurposing, but they're taking that option away from me.
That's true. That is true. So if you have, I mean, in this scenario, we are assuming this company is earning a return on equity of 20%, right? So for you to do better with dividends, you have to also consider taxes, right? So if you receive dividends, you only get here in Switzerland 75% of the dividends, right? 25% goes to the state, to the government. So you would need to, what is 20% divided by 0.75? Can somebody do that in their head? 26 and 26.7%, right? So if you have investments that can earn 26.7% per year, then you would be better off if they paid dividends and you did the capital allocation, not the company. So yes, you're absolutely right, Anza.
I guess it comes down to it's a case by case determination, right? So you need to look at its merits in each individual case.
Yeah.
So to summarize, this example is when you take your dividends, invest in the same company, you will lose money.
Yes.
Because of tax.
Because of tax, yeah. Exactly.
So maybe that's
transaction
the opposite of your feelings when you said they take it away from your own decision making, right?
Yeah.
Anton?
I have a question.
That's right. Having said that, I mean, my assumption would be that I'm not reinvesting in the same company. My assumption would be I find a different, better investment outside of that ecosystem.
Yeah, and it's possible to do that. I mean, for example, we were invested in Apple, right? I mean, they're right now not as cheap as they used to be when we started investing in Apple, and they're still repurchasing a lot of shares. So I was looking at the repurchases. I think they're beneficial, right? But I was selling Apple shares because I was like, okay, they're repurchasing share. We own a little bit more of Apple because of the repurchases, right? But I see better opportunities. So while they were repurchasing shares, I was selling shares to the company to take that and invest it somewhere else because I thought it's better invested in other companies. Yeah.
I think what's new is in the equation is the tax avoidance. So as a stakeholder, you're always interested as well that the business maybe helps you to avoid tax and dividends next.
And also take advantage of undervaluations.
Of course, but it's also in the equation.
Yeah. We have companies that are repurchasing 10% of their shares every year. But Georgina, you had a question.
Yes. So I guess the company is always doing what is the best for the company, and depending on the situations, they're paying dividends or repurchase their shares. And how do you know as an investor what's going to happen next year? Or does it just happen to you? Because, okay, we see, yes, it's better to repurchase, but how, I mean...
Yeah, no, we can't influence...
I mean, what's going to happen. Right?
Yeah, I mean, we can vote. We can vote, of course, right? As shareholders, we are entitled to a vote. And we can also vote with our feet, right? So if we see that the management isn't behaving the way that we think is advantageous to us, we can decide to sell and go to another company. Yeah.
Or if you have a certain percentage, of course, it's the highest organ, isn't it?
Yeah.
Shareholders.
Yeah.
But you need a certain stake.
We are far away from that.
Yes.
But my job is to find companies with management where they make these rational and fair decisions on our behalf, right? And when I see that, they're making stupid decisions or decisions that are advantageous to management, but not to us as shareholders, I need to act.
Now, one question is in terms of tax.
Mhm.
And we are looking at a situation where we continuously build up our investments.
Mhm.
But in the end, we start at a certain point. We have no investment. We have certain funds. We start with these funds to invest,
Mhm.
and at the end,
Mhm.
we want to have funds again, no investment.
Yes.
So looking at the total cycle
Mhm.
and at the tax
Mhm.
by selling all our investments,
Mhm. At the end.
that would be a different story.
No, because while you're investing,
Yeah.
you wanted, this is the compound interest, right? The Zinseszins.
Yeah.
You want that to be as little disturbed by taxes as possible, because every year the Zinseszins effect, the compound interest,
Yeah.
is the most powerful thing that you can have in investments. If you at the end you have to pay a huge amount of tax, right?
Yeah.
But in between you could invest very tax efficiently. You're much better off having a huge, instead of 7 million, having 10 million and paying taxes on 10 million, than paying taxes in between. So you should always maximize and then at the end pay the tax. But we can look at that separately in the question and answer session.
Yeah,
But
okay.
yeah. It makes sense to make more money even if you have to pay taxes more at the end. Yeah. Because at the end, they're not going to tax you 100%, right? Maybe 20%, maybe 30%, maybe 50%. And it's better to pay 50% on a huge amount than to pay 50% on a small amount. Yes, you give more to the government, but you keep also more. Okay, and then this slide is just, showing you the difference between the dividend payer and the repurchaser in this scenario. Obviously, this scenario assumes that the company is undervalued in the beginning and at the end, people recognize that it was undervalued and it's more fairly valued, right? But that's what the companies we want to invest in, so that's why I'm making the case. So we went a little bit or a lot over our time, but it's good. I mean, we can be very informal and use the time as we see fit.